Since the 2016 presidential election, the stock prices of banks of all sizes have experienced a significant increase in trading multiples. And for most of 2017, the bank stocks have traded between 20 to 30% higher than pre-election prices as a result of the Trump bump. This has resulted in a similar increase in pricing for bank acquisitions in 2017. Compared to the first 11 and a half months of 2016, the price to tangible book value for bank acquisitions increased almost 25%. However, these higher prices have not resulted in a larger number of announced deals in 2017, which was on par with the same period for 2016. So what would explain this dichotomy? Crowe Horwath partnered with Bank Director for the 2018 Bank M&A Survey, which explored bank M&A strategies, the environment for deals, views on the U.S. economy, and the legislative and regulatory landscape. According to our survey respondents, 84% say rising bank valuations have resulted in higher price expectations on the part of sellers. We all know that not every bank deal is equal, and for many good reasons, not every bank should achieve increased pricing. Size, geography, profitability, and credit quality are some of the differentiating factors that affect pricing. Many boards of potential sellers become fixated on the prices reported in the media. And once that price expectation becomes locked in, it becomes harder for a deal to get done. As the survey data indicates, 44% of respondents say that these rising valuations have made it more difficult to compete for or attract suitable acquisition targets. The data from announced deals supports this finding. For smaller sellers, the typical size of the buyers includes banks whose stock prices have not experienced the same acute price increases of their larger peers. Additionally, the survey points to this being more acutely felt by private banks and banks in the $250 million to $5 billion asset range. Many of these banks would be seeking an all-cash transaction as a buyer and could not afford the higher prices offered by buyers with fully priced stocks. So what happens in 2018? Rising bank stocks were based on three expected structural changes for banks. First, rate increases from the Federal Reserve, which did happen and is expected to continue in 2018. Second, tax reform, which was making progress through Congress in late 2017. And finally, regulatory relief, which was in question during most of 2017. The survey was completed in the fall of 2017. And at that time, most bank executives and directors expected modest regulatory relief from Congress in 2018. It now appears that may actually occur. As the prospects for regulatory relief became clear in late 2017, the market for bank stocks responded favorably. Additionally, survey respondents expected the Trump administration to appoint regulators sympathetic to banks. This has already become a reality with appointments that promise to balance the needs of the public with a reduction in the regulatory burden. Based on these regulatory trends, the following should be watched in 2018 for their impact on deal pricing and volume. The run-up in bank stock prices yielded a higher price for sellers in 2017. Buyers had currency that was trading at new highs for the post-crisis era, which meant these banks could pay a higher price and still manage earnings per share dilution and dilution in their capital ratios. Regulatory and tax relief should continue to bolster publicly traded banks in their ability to compete for deals with an even stronger currency. However, sellers will need to perform their own robust due diligence on the buyer to confirm the fully priced stock they'll be receiving will hold its value over a reasonable time frame. Higher prices will likely continue to make it more difficult for private buyers to compete for targets, as smaller sellers become enamored with higher prices, which makes it more difficult for smaller sellers to accept an all-cash deal. One cautionary note. In the past, many potential sellers cited the significant regulatory burden as a reason for selling. If regulatory reform becomes law, more institutions could elect to remain independent. If this occurs, we can expect to see higher prices for some sellers in 2018, but fewer transactions. Visit bankdirector.com for the complete results of the 2018 Bank M&A Survey, and read an in-depth analysis in the first quarter 2018 issue of Bank Director magazine.